The biggest mistake that I see so many retail investors make, and unlike some of the others in this list, this won't be a surprise to you, is panic selling when markets tank. This is probably the biggest killer to your portfolio, and what's worse is we all know that you're not supposed to do it, but so many of us do it anyway. I learned this the hard way during the COVID-19 crash when markets plunged 35% in weeks, and like many, I sold off the part of my portfolio that I felt was highly exposed and destined for more declines, thinking it was the rational thing to do. But markets rebounded faster than anyone expected, and by August it had recovered over 50% from the lows, and I missed most of that V-shaped recovery because I was out of the game. Corrections are normal. Markets don't go straight up, and selling only locks in losses, leaving you sidelined for the recovery. Warren Buffett nailed it. Be fearful when others are greedy, and greedy when others are fearful. Lesson 2. Over trading. Day trading is very different from investing. Investing is buying stocks or assets to hold for years and benefit from growth and compounding. Day trading involves buying and selling financial securities within the same day to profit from rapidly changing prices. Day traders actively monitor charts, news, and technical signals, making multiple trades each day to try and predict the ups and downs from 1 minute to the next. When I first started investing, I was so excited by the allure of making quick money that I became obsessed, constantly checking and tweaking my account, only to slowly realize that the more trades I made, the more money I lost. And in hindsight, with everything I now know, I can't believe I ever thought that that was going to work when the odds are so stacked against you. Studies show that 97% of day traders lose money long term. So why go through all of the effort and emotional trauma of constantly checking stock charts and news headlines only to overtrade and become poorer? There's a reason for the old adage that the best investors are those that are dead. Lesson 3, emotion-led investing. Don't chase hype or FOMO into hot investments because somebody told you it was going to the moon. I mean, look, it's easily done. I'll never forget when Snapchat listed back in 2017 and its shares rocketed 44% on debut day, and everyone on social media was going crazy. The price was only going to continue going up. Now, I wasn't going to be the one to miss out on making some quick cash, so of course I piled in the very next day. No research, no due diligence, just the promise of a quick buck from people I had never even met. Now, that's speculation at its finest, and definitely not my finest moment, because within a year I was down over 80% on that investment, at which point I cut my losses and exited fully. I got burnt, and I quickly learned that jumping on trends like that is gambling, not investing. Stick to fundamentals, avoid the crowd, or you'll buy high and sell low. Lesson 4, trepidation. Too many investors wait for the right time to invest, scared of a correction that's apparently always imminent, so they keep cash idle as inflation erodes it. And I covered exactly that in my Investing for Beginners video. But timing the market is a loser's game. A JP Morgan study showed that from 1993 to 2023, missing the 10 best trading days in the S&P 500 slashed your annualized returns from 10% to 5%. 30 years of investing, 5,000 plus trading days, and missing out on just 10 of those has wiped out half of your returns. Time in the market beats timing the market every time. Lesson 5, failing to diversify. So many investors load up on stocks from the same sector or country, or even put heavy weight into property, betting on a small slice of the overall market. And when one of those sectors or regions struggle, their portfolios suffer disproportionately. Research from Vanguard shows that spreading investments across thousands of companies globally lowers risk without really sacrificing returns. Their FTSE All-World ETF provides broad exposure to over 3,000 stocks across 47 countries, reducing reliance on any single market. And obviously, diversified portfolios tend to experience smaller drawdowns and smoother returns over time, which means you're less likely to panic sell when times get rough and fall victim to lesson number 1. Lesson 6 is not knowing when to rebalance, and what I mean by that is taking some profit off the table when the value of one of your stocks skyrockets, and using that profit to buy underweight assets to maintain your overall target allocation. Every now and then we see the price of a stock become detached from its fundamentals, or maybe the company has performed well above expectations. Either way, suddenly your concentration risk is now dramatically higher without you really even realizing it. I don't allow any individual stock to exceed 10% of my total portfolio value, and something that I've had incredible success with is to be quite contrarian with my allocation. For example, back in 2022, when everyone was piling into non-profitable, fast-growing tech stocks, I went overweight into highly cash-generative, quite boring businesses like British American Tobacco. When the market corrected and those fast-growing stocks got crushed, my portfolio was protected, which then allowed me to pivot into those tech stocks at discounted prices. Lesson 7, holding the wrong amount of cash. Now this one is tricky. Hold too much cash and you'll miss out on growth. Hold too little and you can't benefit during crashes. Research from Vanguard shows the optimal cash allocation for most balanced portfolios is somewhere between 5 and 10%. Enough dry powder for buying the dips, but not so much that it drags returns. Their model portfolios with 5% cash outperformed cash-heavy ones by 2 to 3% annually over 10 years. Again, time in the market beats timing the market. And as I just said, my view is that you're better off remaining invested, but rebalancing your portfolio depending on the market, rather than hold a giant pile of cash on the sidelines, which over time becomes even more difficult to invest as it grows, because there's something psychologically difficult about investing a lump sum rather than drip feeding as you go. Final lesson is investing without an end game in mind. I learned this early when I drifted aimlessly for years, dumping money into my account without a target. It's like trying to run a marathon without knowing the finish line. It wasn't until I set a specific goal of how much I wanted and by what age that everything clicked. Hitting my first milestone kept me motivated through the dips because my end goal was more tangible. So define your number, time frame and schedule, write it down and stick to it. You'll soon realize that all of the volatility in between is just noise along the way.